and thank you for joining us for today's segment of The Power of Money. I am your host, Michelle Graves, known nationally and internationally as the Money Lady. And for the last 37 years, I have been committed to bringing information to American consumers on finance, health, wealth, all of those areas, so that you and your family can begin to make sound financial decisions. And the best way to do that, I felt, was to engage in a conversation with experts and people that were experienced. It's not that I disregard family conversations or friend conversations, but in the world of finance and business, you need to do business with people that are experienced, that know what they're talking about, and that have established themselves as honorable, trustworthy individuals. That's how we do it. Today, as so many people are confronting the realities of aging, including myself, because I am officially a senior citizen, the decisions as to how we're going to handle the costs associated with long-term care. And before you say, but Money Lady, that's not going to happen to me, I'm here to tell you that the statistical probabilities that it is going to happen to you are very high. In fact, I believe the numbers are now 69% of people over the age of 65 will experience long-term care situations. And of course, the question always is, with that type of a statistical probability, how am I going to pay for it? And talk to me real about how I can pay for this. I know I need it. I don't want to go on Medicaid to lose everything I own and have nothing for my family and children, but how am I going to pay for this? And so I brought on Randy Gallas, who is a certified long-term care specialist. He has been in this industry for well over a decade. He is the president of Long-Term Care Insurance Agency in Kettering, Ohio, and works with advisors on this critical area on a daily basis. So I brought you an expert, and now you can sit down with a piece of paper and you can learn something about how am I going to pay for long-term care, or maybe I should just let them have the house and call it a day. I don't think so. That's not how we do it in America. So without further ado, I'm going to introduce Randy Gallas, and we're going to be talking about long-term care insurance. How do I pay for it?
Well, thank you, Michelle. Thank you.
Glad to be here with you again.
Great. Thank you for having me on the show.
Oh, of course. You're my expert.
Well, we all try to be experts, but, you know, the thing of it is, long-term care, just about like anything today, is a specialty. So when you look at long-term care, you want to be talking to someone that has done this for a while rather than trying to get it just by yourself off the internet and those sort of sources. So by talking to a specialist, you have the best of options to get a product that will meet your need and meet the needs of the long-term care policy. So today, you had mentioned we're looking at different funding sources.
How do I pay for this thing?
Excellent question.
Yeah.
There are numerous ways to pay for it. And I think on one of your other shows you had an example where we could use reverse mortgages to pay for long-term care.
Yes.
And that is a very true way of paying for it as well. In fact, my mother-in-law had used a reverse mortgage to pay for some of her long-term care costs as well.
Oh, good for her.
So it was very successful, and I highly regard looking at those sort of options to pay for long-term care.
Excellent.
So, well, if we could go to slide 1, I put together like 4 different ways or funding ways you could pay for long-term care.
Okay, can we go to slide 1?
Okay.
Thank you.
Well, first of all, there's always that thing, it's like we could self-insure.
Okay,
say,
well, tell people what that means. When you say I can self-insure, what does that mean?
That's, Randy, we think we can take care of this cost ourselves. Well, maybe you could. Now, not all of us are blessed with having those 7-figure incomes, and maybe if we did, we could pay for long-term care, you know, from our income and savings that we have set aside. But most of us don't have that situation. So, as a result, You know, self-insuring, I mean, the thing that you have when you do that is you're assuming all the risk for that long-term care situation. So, and it can be anywhere from $40,000 to $1 million. And you say, well, how could it be $1 million? An example. Say, for example, you do have an Alzheimer's situation where you're going to need specialized care for a number of years. Well, if you needed care for 10 years or longer, most of the high-quality Alzheimer's facilities are running right around $10,000 to $12,000 per month. Not a year, that's per month. So if you do the math, you'll come out to over $1 million that you could have expended. So even though you may have $1 million in assets, there is always chance that you may have to spend through your estate to pay for your long-term care.
Well, if I might interrupt, $1 million actually is conservative because the average lifespan of an individual with diagnosed Alzheimer's disease can be as lengthy as 20 years.
Yes, it can. Yes, it can.
And that is, you're done.
Yes. And you say, well, Alzheimer's may not happen until I'm in my late 80s or 90s. I know of examples where this situation happens to individuals in their 40s.
I do too. Shocking, but it's true.
Right. So it can last, like you mentioned, for at least a long period of time. So, you know, when you talk about self-insuring, yes, we always have the ability to do that, and that is our fallback position. But do we really want to assume all that risk? That's the key thing. So if you move from self-insuring and move into the next one here that I have here is a traditional long-term care plan.
Okay, can we bring that slide 1 back up, please, so that they can see?
Right.
Okay, there we go.
So, traditional long-term care, that is if you don't do anything else, that is one thing you should look at. And again, when you look at traditional long-term care policies, again, what you're doing is transferring that risk, Michelle, to the insurance company. Where are you taking off of your shoulders and saying, woo, okay, the insurance company has the risk now. So I put on this chart, as you can see here, some pros and cons. Again, all you're doing is you're paying an annual premium for a policy. And by doing that, you're leveraging dollars for a pool of money. So today, if you bought a policy, and we'll say it was worth $4,000 a month, you may have a pool of money of $150,000 available to you immediately. So if a long-term care event happens next year or next week, you would have this resource available to pay for long-term care. That's difficult to do if you try to invest that money, like in the stock market, because you can't take a premium and invest that and have $150,000. So by using a traditional long-term care policy, that is one way to have a pool of dollars available for long-term care and leverage for your long-term care. Now, some cons with that, of course, with every good, there's always some things to look at. You will have to continue to pay that premium for your policy, just like you do for your automobile policy, just like you do for your homeowner's policy, until you need the care. And then at that point, with all long-term care policies, they have a waiver of premium, which means you would not pay for that policy anymore. So the day that you went on claim, your premiums would stop.
Well,
so
that's nice.
It's one of the key features of long-term care that many people don't realize.
But a lot of people, when I talk to them about long-term care, and I wrote an article in the Enquirer, Cincinnati Enquirer, about devastation from the absence of long-term care, but the repeated concern I hear is, I'm paying this monthly premium every single month. And what if I never use it? What if I'm one of the people that never uses it? Maybe I die. Maybe I never get sick. Then I've paid in all that money. Of course, the counter to that is that you pay car insurance and you never have an accident, or you pay fire insurance and the house never burns down. But this is a little different because it's a little bit more personal.
Correct.
And that is, you're paying for your long-term care. Before we go further, define for me, what is long-term care?
Good question. Okay, long-term care basically consists of a component. I look at it more from the standpoint of looking at it from formal care and informal care.
Okay.
Okay, and it's mostly dealing with what they call custodial or personal help. And you'll hear today things like activities of daily living. So when you can't perform like 2 out of 6 activities of daily living, which include things like bathing, dressing, eating, or using, you know, bathroom type of facilities or things like that, or a cognitive impairment, that is a long-term care event, especially if this occurs over 90 days or longer. So basically long-term care will cover the costs of taking care of you if you can't perform 2 out of 6 activities of daily living. So that's basically the definition of long-term care. Custodial personal help, where most insurance doesn't pay for.
Now, many people, this is back to bad information, think that Medicare pays for long-term care.
Not a dime.
Not a dime.
Not a dime.
Not a dime. Not a dime.
We want to stop that because, again, when we have the conversations over the phone with someone, they'll say, well, or when they come to the office, well, the government will pay for my long-term care. And I have to let them know that maybe, but only way to do that is for you to spend what you have saved over your lifetime for your cost of care, and then spend that down, if you're a single person, to $1,500, and then you would be able to go on and qualify for Medicaid.
But that's not Medicare.
Right. Medicare only lasts for 100 days. Okay, so the first 20 days you might be covered with some care, and then there's what they call a Medicare gap for the next 80 days where you would either pay out of pocket for that care or you'd have some kind of a supplement. But when day 100 rolls around, it's all out of your pocket. So there is no more care after day 100. And we hear this so many times where they say, Randy, we've experienced it. Or Randy, we've experienced with mom and dad or with grandparents. And it's like we didn't realize it was that devastating to my family or to my parents or to my grandparents. They've spent basically everything down. The whole estate is gone. I hate to say this to all the baby boomers out there, but baby boomers, you may not be getting that inheritance you once thought you were going to get. So.
Well, but I think it's a very valid point, because if planning is not in place and the proper instruments are not in place, then the probability is quite high that you have nothing coming.
Correct.
And that's something we probably need to talk about today as well.
Exactly.
Okay.
So, again, self-insuring, possibly, if you have enough assets to insure, you could do that. Traditional long-term care, basically for us in the middle, that, you know, we have some assets, we want to protect those assets, and so we look for long-term care. Now, the thing that's happened with the long-term care industry is we've seen some changes there, especially in the insurance carriers are basically looking at health records a little bit more closely than they did in the past. So my advice to everybody looking for this product is don't wait till you're 65 to 70. You know, think about doing this in your late 40s, early 50s. And I understand that there's other costs and things that come into play there. But again, if you just get something that's small and add to it possibly, you could satisfy some of those long-term care situations.
Well, I certainly would have to say that based upon statistics, and you're probably more on that than myself, the number of younger people is literally growing by leaps and bounds. People that are under the traditional older citizen age. These are people in their 40s and 50s. They are, in fact, doing long-term care insurance.
Correct.
For that very reason, they can get lower premiums, better rates, excellent health.
Exactly, exactly. In fact, all of the carriers today, the prime carriers, they've moved to what they call gender-based pricing, which means...
let's talk about that.
Let's talk about that. Years ago, everybody was on long-term care based on what they call unisex. Didn't matter if you were male or female, the premiums would basically be the same in terms of the cost. And now, they have shown over the past several years that females are using 70% of all the long-term care policies today.
My word.
70%.
Well, we're not dead.
No. But the thing of it is, the fact remains that females are using these more because they have a tendency to live longer. And so as a result, the insurance carriers had to take a look at pricing, and so effective by February 1st, there will be no carriers in the industry that will have unisex ratings. They will all be gender-based, meaning males will pay a rate, females will probably pay a higher rate for their long-term care.
Well, I would definitely think so. I've heard it said that as much as 40% higher.
Yes, in some cases as much as that.
Because being female.
Right.
But you know, insurance companies are not nonprofit entities. And at the point they cannot generate a profit from that particular activity, they're going to exit the industry. I mean, didn't your industry experience a lot of that? Yes.
In fact, if you look at MetLife as one of the major carriers, they got out of the industry in 2010, where they left the industry. We had Prudential that left the industry, I think it was in 2012. They were two big insurance carriers that basically did exit. Now we have some other carriers like Transamerica that exited the business years ago but came back into the business. So I think as we see the interest rate environment coming back, and we're starting to see that, we may see some of the bigger carriers move back into the industry again. In fact, we've heard of a carrier that did a lot of the multi-life and group type plans for businesses looking at entering the marketplace again. So,
that's encouraging.
So we see that happening today. So yeah, that is very encouraging because we like competition.
Yes, yes.
Keeps
everybody honest.
Exactly. There used to be about 120 some companies out there. Today, there's probably somewhere around the neighborhood of 40 long-term care companies still in the marketplace. Yeah. And so the bigger carriers like the Genworths and like the John Hancocks, Mutual of Omaha, New York Life, those will always be there. So when you're shopping for long-term care, make sure you shop with a company that you know is going to be there. And those companies will be there in the future.
Okay.
The industry is 40 years old. So Genworth is celebrating 40 years this year.
My goodness.
In long-term care.
My goodness.
Yeah.
My goodness. Yeah. Now they tend to be a little bit more strict, wouldn't you say? For their 40 years of experience means
40 years
something.
of experience, right. And when you're looking at 1.5 million policyholders, which is quite a few.
That's quite a few.
Right. So there's safety there. So those carriers will be there for you when you need, and not just picking on that particular company, because all the carriers I mentioned have a strong balance sheet, strong record. They're all A-rated or A-plus rated companies that will be there in the future.
And those are companies also that your company, as a broker, represents.
So, kind of getting back to that slide, let's get back to that slide there on the options.
We can go back to that first slide.
Right.
Okay.
Let's talk about some other sexy things that have happened in long-term care. And there's a product now that's called hybrid plans. It's becoming very popular, and it's gaining popularity all over. And it's been around for years, but just recently we've had a lot more success with the hybrid plans. And one of our carriers that we use, they use either a life insurance platform or an annuity platform, again, to leverage long-term care benefits.
Explain how that works.
Let's talk about that.
Yeah.
First of all, let's look at an example. Could we put up like an example?
Okay. Can we move to slide number 2?
Yeah.
Okay. William and Lynn.
Okay. This is probably, these are real live cases. I don't have last names on there, but these are real live cases where these individuals had taken money from an annuity they had purchased years ago. And in this particular case, they had put in $50,000 in this annuity product, and now they have, I think the slide says like $100,000 is what it says on the slide. So what happened is over the years, that money had grown from $50,000 to $100,000. So if they needed long-term care and they were thinking about using that money for long-term care, then they would have to pay tax on the money coming out of that annuity to pay for their care. But due to some law changes, it was a law that was enacted back in 2006 that came effective in January of 2010, they're able to do an exchange of that money from that annuity over to a long-term care platform without paying taxes on that exchange.
Let me make sure I hear this right.
Say that again.
Okay, let's do this again.
Okay.
What you're saying is that they could take their annuity that they had purchased years ago and it had accumulated value, and they could exchange their annuity into a long-term care insurance contract with no taxes.
That is correct.
No taxes.
In that transfer.
In that transfer.
In that transfer, correct. So,
And that's been on the books since 2006?
well, that started, that was called the Pension Protection Act.
Right,
Yeah. Right, and so it was, basically came into being in January 1st, 2010.
I can guarantee you most people do not know
They
this.
do not know that. Happens. But it's a great way to take money that was put aside for years and years ago, and now it's grown, and now they're just doing an exchange of that money over into this long-term care platform. And by doing that, depending upon what your age is, you could leverage that anywhere from 2 to 3 times for long-term care.
So that means, by example,
Okay?
if you have a $100,000 valued annuity, and these are non-qualified monies, just money, money. It's
right.
not tax, just money. And you moved it into a hybrid product, the $100,000 would become up
$200 to up to $350,000
in long-term care benefit.
Yes.
Wow.
Yes. Yes.
Wow.
And I think in this particular example that I had, it was like this 100,000. It's age-based, obviously. So the more senior you are, the less of the amount that amount's going to be there for the leveraging. But in this case, I think the clients were in their 70s, early 70s, and their $100,000 transfer over to this carrier lets them have $221,000 of long-term care benefit.
My goodness.
So they just grew the size of their estate by $120,000 for long-term care.
So question, what if they die before they use the benefit?
Good question. If they die before they use the benefit, that particular $100,000 will come to a beneficiary. Whatever interest it accrued over the years would still go back to a beneficiary. Or if it was a husband and wife, the wife could have access to that long-term care benefit as well, or decide to use the money as she please. But go ahead.
So the $100,000 that could be leveraged up to $300,000 in actual benefit.
Correct.
If a person died, the $100,000 would pass on to their named beneficiary, or would the larger amount?
The $100,000.
Okay, so there
for the annuity concept.
For the annuity concept. That's very nice.
Well, it's a win-win because...
Well, yes, it is.
Because, first of all, you're not paying any annual premiums, and you immediately have this leveraging that's taking place immediately the day that money transfers. And so there's no premiums, there's no rate increases over the years, and guess what? If you don't use it, don't lose it.
You don't lose it.
Correct.
Well, that should answer the question for people that have lump sums of money and don't want to deal with the downside risk of making a premium and never using the contract. Because there is a legacy component, correct, in that?
Correct.
Okay,
Correct.
that's nice. That's nice.
So,
but what if you don't have a annuity? What if you don't have just a regular cash annuity? Are there any other vehicles?
Absolutely. In fact, if we went back to that one chart, the 4 options chart that we had
Okay,
there.
let's go back to chart number 1. Okay, chart number 1.
And
okay.
You can also use what they call a whole life insurance policy.
Okay.
And also have the hybrid concept work just as well for that as well. So in this case, it's the same concept as the annuity. Only here, you either have a long-term care benefit, and if you don't use it, you have a death benefit. So in reality, what you're purchasing is a policy that's going to give you the leveraging concept for long-term care, along with the leveraging concept for a death benefit, if you don't need it.
Explain how that works again.
Okay. Once again, let's move to the chart, and I think it would be
3.
Asset Care, where we talked about Asset Care 1.
Okay, chart number
And
3,
it'd be Jim and Barb, I think, is on the chart.
Jim and Barb, yep,
Here's Jim and Barb, and they're in their 60s, and they basically had set aside $100,000 that they had just sitting there for something, long-term care possibly. Well, here is where they could take that $100,000, like the annuity concept, and transfer that over to the carrier, and they would have immediately available $195,000, almost 2 times of what they had originally, into either a death benefit or a long-term care benefit for each of them. Doesn't matter if it was...
For each of them.
That's, well, basically, it's husband and wife.
Right,
okay, husband
right.
and wife could be jointly owned on that policy.
So even if the life insurance contract was owned by the husband, by
Correct.
example, then when they did the exchange,
Right.
it could be
Both.
now both, husband and
Absolutely.
wife.
Absolutely.
Do both of them have to meet underwriting?
There's a little bit more underwriting on the asset care because it is a life insurance product. Where we talked earlier with the annuity care, there's more simplified underwriting where they don't get into a whole lot of detail there.
Right, right.
So there's a little more underwriting with the asset care, but again, less underwriting than a traditional long-term care policy.
Right.
So you have the advantage of that also.
And let me just be clear, because this is so remarkable. You can take $100,000, leverage it to $195,000, and that $195,000 can be used to fund for your long-term care insurance policy.
Correct.
And if you don't use it
Okay.
at all because you
Right.
expired, then those proceeds pass per beneficiary designation.
Correct. Non-taxable.
Non-taxable.
Non-taxable. You just increased the size of your estate by 100%.
You certainly did.
Yeah, at non-tax,
You
no taxes
certainly
due,
did.
because it's either a death benefit or a long-term care
Right.
benefit.
And that is actually a policy because some carriers, and we're hearing more and more and more about this today, that have a rider on a insurance contract versus an actual policy that is designated to do that. What are the benefits of that?
Well, there are some insurance contracts that are there today and whole life contracts that what they have called an accelerated death benefit, where you could, if you were terminally declared that you had a terminal illness, you could actually use the proceeds of that life insurance product to pay for your long-term care. However, by doing that, you're taking away the advantage of having that life insurance. What if the spouse needed that protection on the life insurance? So what you're doing is basically spending down your whole life policy.
Ah, and under this scenario, the integrity of the policy is intact.
The integrity of the policy is intact, and there'd be a death benefit will be paid to either the husband, the wife, or the estate.
That's sweet.
Exactly. Tax-free.
Tax-free.
I keep
well,
wanting
no,
to say
no,
this
there's nothing
tax-free.
wrong. There is, listen, we are all, if we are prudent spenders, it is our responsibility to manage our affairs so as to minimize taxes. I didn't say tax avoidance, that's illegal.
Right.
But certainly, it is prudent. I mean, that's why they're on the books. I mean, it may be repulsive to some, but I think it's a wonderful thing if you know what you have.
And these products are there.
And they're there.
Exactly. And that's why we try as hard as we can to get to the financial advisors, to try to get to, CPAs, to let them know that these instruments are available to their client base so that they can, save some dollars in taxes. And,
Yes.
And use the leveraging concept. The key word here is leveraging for all these products.
And of course, for viewers, the leveraging is taking X dollars and watching them grow
Right.
exponentially just by moving them into a designated product.
Correct.
You can watch that happen. That's powerful.
It's extremely powerful, and the word guaranteed, of course, today in a society where you don't hear that word too much, guarantees or guaranteed, they're all guaranteed. So you're not going to, quote, lose anything from this benefit. So it's there. And in case of the asset care that we just talked about, on that $100,000 transfer for this for the life insurance, long-term care, death benefit, If you wanted that money back within 5 years or 6 years, all that money would come back to that person.
Really?
So, correct. So
Is there a penalty for that?
there is no penalty associated with the asset care using the life insurance product.
Sweet.
So,
Gosh.
yeah. So, on the annuity, I forgot to mention that there is a small surrender fee on the annuity. Like all annuity products, most of them have surrender fees. So there would be if you decided to get out after 5 or 6 years, but you would more than likely get back everything you put in. So,
But that is illogical, Randy, because if a person knows that they're going to have to deal with long-term care, it's a reality. It is what it is. You're either going to let an insurance company leverage or you're going to do it.
correct.
And if you do it, unless you have deep, deep pockets, it just doesn't make any sense. I think many people, truthfully, are confused about what risk management is, and that's even down to funerals, which is you buy insurance so that they carry the risk of your death. You buy insurance because they carry the risk of your long-term care needs. You buy insurance because they carry the risk versus yourself.
Right.
And it's cheaper. It's immensely cheaper to let them carry the risk than you to do it, don't you think?
Absolutely. Absolutely. And one thing that I left out, that all of these products, when you look at asset or hybrid type products, you have the ability to add additional riders to those products to either take them out to a lifetime benefit, which is like unheard of today in the traditional long-term care policies because there are no longer lifetime products available. Or you can extend them for another like 36 months or 50 months or a lifetime. So you have the ability to add to those policies an additional benefit in that particular situation. $100,000 that we had talked about on the Asset Care One could turn out to be almost $400,000 of benefits.
Oh my goodness, and that's because of the add-on
Additional
fee.
rider.
Okay, the additional riders.
So you can do that.
And
Or-
how expensive is that?
well, in that particular example on the Jim and Barb, if we had that, did we have that back up again, the Jim and Barb?
Jim and Barb, if you could put that back up, please.
I think that was number
Three.
Yeah.
Yeah, if we could see that, yeah. Okay, I see here.
So by adding that additional rider, that would cost a one-time lump sum of $9,000, or you could divide that up and pay that annually as well. It would be something like $800 a year. So for $800 a year, you could have a long-term care rider added that would generate another $195,000 benefit.
That
Yes.
is really,
It's incredible.
it is incredible.
And it's guaranteed to be there. And all these products grow at a guaranteed growth rate of 4% on the actual benefit itself.
Right. And does that is strictly for the long-term care
Correct.
portion? Okay. If they were to die,
If they were to die.
they would receive, or their heirs would receive what their investment was plus interest.
On the asset care, they would get a death benefit. There's a death benefit because it's a life insurance
Oh,
policy.
that's right.
Right.
There is a death benefit.
Right.
Okay.
So they would get that benefit.
It's an amazing thing. I think that the industry has not done a good job of educating the consumer because people have this kind of insurance, but insurance is the foundation of wealth. It is. It's the foundation of people die and it transfers tax-free. And I mean, after your funeralization, that's a nice chunk of money for your children
Yes, it
or
is.
your grandchildren. The benefits are just extraordinary. Well, go on. I don't want to get into a side
No, that's,
conversation about insurance.
And that's why it's so important for this show and for us as advisors, long-term care specialists to get out and kind of, educate, what's going on in the industry because these changes are taking place every year. We're seeing more and more changes to the industry. 40 years ago, I mean, most of the long-term care policies, as you know, were probably just nursing home. Today, the policies are very comprehensive. They cover everything from home care to assisted living to nursing home to hospice care. all types of adult daycare services. In fact, one lady, in fact, therapy, whether it's occupational therapy, speech therapy, physical therapy, and she was just ecstatic that it covers therapy. I didn't even know that. So there are so many features built into policies today, and even these hybrid products would cover those things as well as a traditional plan.
Very, very nice. Are there any other hybrid options?
Absolutely.
Okay.
And I knew you were going to ask that question.
Okay.
If we could go to, I think it's the 4th slide.
Don
And it was Douglas and Carol. Doug and Carol.
Fourth slide, please. We can. Okay, Douglas and Carol. Okay.
Yeah, Douglas and Carol, basically they had IRA money. So, in fact, this was one example, but and I should have brought that one along, but I didn't. Where a gentleman, he was 72 years old.
Okay.
And he had $1.3 million of IRA money only.
Okay.
He did not have any non-qualified. It was all qualified, either IRA money, things like that.
401k.
401k, combination of qualified money. So he says, how can I use that to leverage for long-term care? Well, again, we can do that.
You can take IRA money and tax-qualified money and leverage that
for long-term care.
For long-term care?
Right. This gentleman took $170,000 and he has $400,000 of long-term care benefit.
Immediate.
Immediate. Now, you say, well, geez, Randy, there's got to be tax due on that money. Yes, there is tax due on that money. The government's not going to let us get away with that.
Exactly.
Okay?
Exactly.
So, but what they do is that transfer of $170,000 transferred tax-free to the carrier.
Okay.
Okay. So they didn't have to pay tax on that money. All right, when he did the original transfer. So the carrier every year will take care of his tax accountability for them. So 6.5% or whatever that amount was, about $33,000 or $4,000 every year, he'll pay tax on 6.5% of that transfer.
Wow. But it's not a lump sum immediate.
Correct.
It's over time.
So what's the news there? Well, at age 70 and a half, there's a thing called RMD distribution, right?
Required minimum distribution. Right.
So basically, the insurance carrier is taking care of his RMD problem that he has anyway. And so this money is sitting into an annuity bucket and then falls down into the long-term care bucket tax-free. So over time, all of that money would have been spent down into or moved into the long-term care bucket. And guess what? He now has this long-term care benefit out here tax-free to use.
That's nice.
Right.
How many people know about that?
Probably very few.
Probably very few.
Yeah.
And my hope is that some of these advisors that are watching the show would be moved to contact you, because this is such a specialty. This is such a specialty. You can't possibly know all of these nuances and be a general practitioner.
Michelle, I just read an article the other day. There is $18 trillion, they say, in IRA money sitting out there. It's
18 trillion.
Are you kidding me?
Are you kidding me?
I know. I just can't hardly believe that. But there's monies out there that could be used, and we could solve a lot of our long-term care funding issues
immediately.
Immediately.
Just by
moving
money from one bucket to another bucket.
Exactly.
Bingo.
Exactly.
Done.
With no risk. There's no risk to doing this. So even if you decide that you didn't want to make that transfer, the carrier would send the money back. So there's no risk on the individual.
But not to cut you off, but $18 trillion in IRA money.
That's what they say in qualified money.
Oh, well, they would know. The
there.
government knows. The government, believe me, they know it. They know what, because taxes are going to have to be paid. When, in this particular illustration, taxes would be paid per diem, not per diem, per annum, every year, by the insurance company on your behalf, or you're going to pay them?
You're going to, yeah. They're going to take the money out of that annuity that was sitting up here, that IRA annuity, and basically send you a 1099 at the end of every tax year where you would pay tax on what was withdrawn from the annuity bucket.
And the annuity bucket would be there to fund the long-term
long-term
care.
care.
Now, say you never needed long-term care because
Okay.
you hear it all the time. Oh, I'm not going to die. I'm like, oh, really now? Okay. They've got this money in the bucket, and they die.
Okay.
Then what is the status of that money in the bucket?
It's a death benefit. It gets passed along tax-free.
Ah, love it.
Yeah.
Love
Tax-free.
it. So the funding to carry the long-term care from this annuity, this IRA annuity, that funding amount is 3 or 4 times.
Probably. Pretty close to that.
So you got
Depends on the age.
Okay, so you got $100,000 IRA annuity that you're leveraging to $400,000
Could be.
to pay for long-term.
Long-term
This
care.
is illustration.
Yep.
We don't have our calculators out, but if you don't use it, it still conveys to
A beneficiary.
a beneficiary.
Or
Not
the estate. Or the estate.
Or the estate.
Now, let me take this one step further.
Okay, please do.
Because this is an important part. In this case, this was Douglas's IRA.
Okay,
Okay, so theoretically, you know, he has to use that money for his benefit.
for
'cause it's
his
IRA.
benefit, yeah.
When we did this transfer, or over to the asset care platform, we could do it jointly.
Wow.
Jointly, meaning that Carol could also have access to the pool of dollars for long-term care. Even though it was Douglas's IRA
money.
Carol would also have access to it for her long-term care.
This is powerful. this is powerful. And what comes to mind is a situation where a couple, say they're a younger couple, their health is great, and they do have IRA assets that they've accumulated in their 50s.
Okay.
And husband, wife, wife has a family history of Alzheimer. Wife has. They should do this now because she's not going to get coverage for long-term care at the point she's diagnosed with Alzheimer. That's over, correct?
That's correct. That's correct.
So this is a tool, a planning tool, where couples can begin to fund, in today's dollars, a future need based upon the power of leveraging, and can use his product to cover him and her. So if she does come down with Alzheimer, there will be a bucket of money available. Am I hearing this right?
That's correct.
This is powerful. Parkinson's for the man. And viewers, let the camera come my way. Viewers, I know you don't want to get Alzheimer. Do you think a person with Alzheimer wants to have Alzheimer or Parkinson's or all of these dreadful, dreadful disease, cancer? But we're living in a day and age where a lot of things happen to good people. And this is a venue for your planning. For many of you that have family members, you're already taking care of parents with these conditions. They had a stroke, and now the family's trying to figure out how to pay these bills. This is an awesome thing. Can a family pay the premiums for this?
Absolutely. Absolutely. Sure.
I'm just thinking of how family members can pool their own resources in anticipation of a need for their parents.
We've seen it.
You have.
We have seen it. In fact, I'll even share an example where you mentioned the thing about Alzheimer's.
Right.
Husband and wife, he was uninsurable, she was.
Okay.
Okay. And she has a policy. She bought a traditional policy. And so she was so excited about the policy and the benefits of that policy, knowing that she's going to have to pay about $8,000 a month for her husband because he now has moved into a memory care unit. That's $100,000 a year that she's paying. She has 2 children, and she actually, they're 40 years old, purchased long-term care policies for their children, for her children.
She did.
Absolutely.
She wrote the check.
She wrote the check. There's one in California and there's one here in Ohio. So she wrote the check for both of those.
of them.
Yes. She was that afraid that there might be some sort of situation that happened, you know, down the road, where she just decided to do this. Now they're young, so the premiums are a lot less,
Right.
of course, and so that benefit will continue to grow over the years. So when you purchase a policy, all the policies we design basically have inflation protection built into them. So today, that $150,000 is going to be maybe worth $400,000 or $500,000 in the future.
I have a question.
Sure.
And that is my previous guests who were just awesome on reverse mortgages. And they talked about the difficulty of your industry, long-term care insurance, as well as their industry, the reverse mortgage, and all of the concepts that make long-term care insurance such a challenging industry for awareness. What would make a person, if you could overcome the price objectives, what would make a person not want to do these plans?
You know, I can't think of anything.
Try.
I can't think really.
Because I'm sure you've had people that you've shown them these elegant illustrations, you've shown them the benefits, you've shown them the statistics, and they still walk away. What is that?
I think a lot of it is, I'll say this, denial. I mean, I think a lot of us are in denial. We just don't think about that long-term care component as we move. And I look at, coming up on the Super Bowl, I look at things like a football field, where we start out in one end of the field, then we move to the other end.
Okay.
Well, the baby boomers are past the 50-yard line.
Definitely.
Okay? And they're heading for the end zone, okay, or the goal, they're heading to the end zone. And so I think that as we get closer to the end zone, we may see the need. But earlier on, we just don't, because we have other priorities in life, if you think about it.
Yeah.
I had 3 girls, there are college costs, and that's expensive, and mortgages and things like that. And so you're looking at things that are competing, that are paying. So, but if you can pay for it, the only thing that I can think of would be that you just aren't there yet. You haven't experienced a long-term care event with either a family member, a relative, or someone like that. We all have cars, we have automobile insurance. We don't think about writing that check out every month. We just don't think about it. It just happens. And yet, when you come to the long-term care, it's like, ooh, it's like even though the odds of needing it are a lot greater than having this automobile accident.
Oh, please.
We still are going to pay. Every once in a while, I'll say to someone, do you own your home? And they'll say, absolutely, Randy, we own a home. We don't have any mortgage payments. And I'll say, good. You can cancel your insurance now. And they'll say, are you kidding me? We can't do that. We can't cancel the insurance. Why is that? Well, in case something happens.
Right.
Well, guess what? That's all long-term care is. What insurance or what do you have as a plan out here in case something happens?
Well, ironically, and this is not dealing with long-term care, but my Android was starting to act a little wacko. And last month, I canceled the insurance on the phone because I said, this is ridiculous. I'm paying $9.99 a month, and I take good care of my phone. I don't abuse it, business use. And would you not know, a month after I canceled the contract I've been paying for years, something happens to the phone.
Exactly.
And that's called self-insured.
Yeah.
And they said, Miss Graves, you canceled your insurance last month. And I was like, oh no. And they said, but that little replacement is $100 and something. And you can go to this store to buy it, or you can order on internet, but we can't help you. And I was steaming because it hit me again. Insurance is about risk management. When a thing happens, I could have gotten a replacement and got I just was so angry. But it kind of reinforced when people think they can beat the odds. And as I said, in my case, with just a smartphone, I had paid premium for 3 years. Right. And I did the math. And now I'm looking at the replacement cost, and I'm like, dumb, dumb, and dumb. But it does kind of suggest that people can't make sometimes the transition. I think that, and you have a beautiful illustration about long-term care in your packet that I've seen. And long-term care is that piece that connects everything else.
Right. Yeah, all that everything else is things like IRAs, things like mutual funds, things like your 401ks, things like your Social Security, things like pension plans. All of those things, without having the long-term care component in that linkage, basically you will spend those down to pay for that. And that wasn't the intent. The intent is we work 30, 40 years or whatever it is, and then basically, boom, we have this event that occurs out here, and now all that we've saved and accumulated, we're spending down to pay for this event. So by having that piece in there, again, you're leveraging, again, to have a benefit out here to pay for anything that could happen. So you can keep your IRA money, or you can keep your 401k money, or you can keep your savings and investments and mutual funds and keep those growing. And by having that piece in there, completing that financial linkage, so to speak, you don't have to worry about it, because that risk has been placed on the carrier. And that's all we want to do. Let them have the risk so that we can enjoy our retirement years. Well,
it's been said that Warren Buffett, the billionaire that he is, has long-term care insurance.
Actually, you're absolutely correct. I did read that he has long-term care.
Bill Gates does as well.
And Bill Gates has long-term care insurance as well.
So I figure that with the super rich, if the point they're willing to let an insurance company leverage so that they can preserve their assets for their wives and family, or trusts or whatever instruments they have, whatever they choose, that's a very powerful statement.
Correct. Correct. I have had situations, there is a business owner in the Dayton area that is worth about $13 million, and she had called and requested long-term care for her and her husband.
That's beautiful.
And, and I just came out and said, it says, really, why do you, I mean, you could self-insure.
Right,
I mean, I actually tried to sell my, not even sell the plan, as she said, and because of what you just mentioned. They have places like trusts and transfers and legacies and things that they want to continue to fund endowments for years and years down the road. So, I mean, that's the rationale for doing with it. And again, they can afford that small premium, even though it's, they can afford that.
But honestly, I would submit to you that the average individual cannot afford not to have this.
Yes, it basically hits, it hits
because
home.
I tell you, and in the remaining moments that we have, philosophically, I am deeply offended that a person works their entire life and accumulates and saves and puts aside and struggles through retirement only to find themselves with Alzheimer or Parkinson's or some other degenerative situation, and then lose everything. There's nothing for the children, there's nothing for the family, and it is not improper for the federal government to require you to spend down everything and become poor. That's not out of order. What is out of order is that somewhere in their thinking they forgot a piece of their story, which is, what do I need to do to make sure that my children have something, or the house that I labored to pay for, that they have an opportunity. The loss is just horrific. I mean, it's unconscionable. So some people can say passion, and I said life is about passion. Life is about ordering your affairs so that your family continues, your grandchildren have a jump start, and that you can leave a legacy and a memory that's deeper than saying, well, Pops or Grandma were really nice. You can say, Grandma left me $1 million, and I'm using that to fund my company and to pay. I mean, exactly. That's what, to me, wealth is about. it's so much deeper than just living life as an experience and then you become just skeletons in a box, you know? You have any thoughts before we wrap this up?
I think that's a great way to explain it. We do want to leave a legacy. We do want to leave something behind.
Yes, we
do.
do.
And to fund either a company or an education for grandchildren.
Something.
And so we work so hard to get there.
Yes.
So why give it away?
Yes, and that's
just,
my thing.
yeah.
Why are you giving this away?
When we have products and vehicles to make this work for everybody.
Yes.
Okay, we do. They're out there. They're available. So I just wanted to summarize all these things that for financial planners need to be aware of these things. They need to share these things with their clients.
Okay.
And with CPAs the same way. Now the tax season is underway.
They need to know this.
They need to know this.
Well, wasn't this amazing? I'm telling you, I'm on a roll in 2014. I'm going to bring it to you straight. Tell your friends to listen in, watch on YouTube. Randy, what is your telephone number?
It would be 937
937
294
294
1415.
1415. That's Randy Gallas. He's the president of Long-Term Care Insurance Agency, headquartered in Kettering. They are the largest long-term care insurance brokering specialists in the state of Ohio. They service throughout the United States, and you need to give him a call. I'm just telling you that. You need to give him a call and stop playing roulette with your lives. On that note, I'd like to close by thanking you for being a part of this 1 hour experience. And as always, I send you great love. God bless you, and see you next time. I'm Michelle Graves. You take care.